You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program for you, the busy financial advisor and asset manager who's out there and you're maybe trying to dip your toes or your client's toes in those options waters, but they're deep and they're dark and they're stormy and kind of scary. So don't worry, we're here to guide you. We are the beacon, the lighthouse through those dark and stormy options waters. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Many ways for you guys to get our content. About a dozen other shows we do on the network, including this fine program. Easiest place to find all of them is the mothership, the flagship, theoptionsinsider.com. Got all of our other great content up there as well. Text and written and all sorts of great stuff. Breaking news from the options market. Of course, you can always subscribe in your leading platforms, iTunes, TuneIn, and Stitcher. You can always grab our mobile app as well, which is probably one of the best ways to actually get the full, deep archives of our network going all the way back 11 years now, which is scary, but quite a lot of content there. So if you're looking for some options content, a lot of great educational content there as well, that is the place for you. And of course, however you listen, live after the fact, not doing live this week. There's some connectivity issues over there in Puerto Rico. We'll get to that in a bit. But usually we do live this one as well. However you listen, though, live after the fact, hit us up, questions, comments, insights. We do like to hear from you guys. In fact, many of you have done so. So many, in fact, that we're going to devote an entire show to it today. But before we get to that, let me welcome on my cohorts in Advisors Option Crime, starting off with, let's go up north first, all the way up. Usually we go to the hinterlands of Maine. We're going to dial it back one notch, go a state or so south to New Hampshire, where we are joined by Matt Oratz, the principal and founder over there at Options Research and Technology Services, a.k.a. Oratz. Matt, welcome back to the show, sir.
Thank you, Mark. Well, Chris got his wish. After we talked about him on the NASDAQ show with Jill Melandrino, I've been invited on that show, so he'll be able to watch me and make comments next time. So you got your wish, Chris.
You'll be able to make mean faces at Jill, just like Chris, and scare her during the interview. That'll be good. You also mentioned our other cohort there holding down the fort in Puerto Rico, which just a few minutes before showtime had another power issue. Luckily, you guys over there at Swan are prepared and ready to roll with the punches. He is, of course, Chris Hausman, the man about town and the major domo of all things overlays over there at Swan. Chris, welcome back to the show, sir. How are things going down there in the usually warm and sunny Puerto Rico region?
Yes, it's usually warm and sunny, and thanks for having me back again. Yeah, we're going through another power outage, but we're pretty prepared here for all this. We got the generators running and the satellite internet going, and good day to you, Mr. Amberson. I don't think you're ever going to let my my Hollywood debut go away anytime soon, are you?
No.
All right. With the gang assembled, like I mentioned at the top of the show, you guys have been bombarding us with questions for quite some time. We always have great guests, great discussions, great topics on the show, so we never really have time to sink our teeth into a lot of these questions, so we're going to do that today. You guys asked for it. You're going to get it. A special full episode listener question palooza here. So we're going to open up the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Welcome to the office hours. This is the portion of the show where you guys take the reins. Pretty much anything is fair game, except Matt's personal life off the table, or at least for this episode. But pretty much everything else out there is fair game. Let's see. Let's dive into it. Let's just get right into it. So we have so many to get to. Let's start off. This is a question. I guess kind of a comment, actually. Comment and question. Excuse me. Comes from Avery03. He or she asking, hey, this is an interesting piece I found in the street about when to fire your financial advisor. What are your thoughts on it? And the article was entitled, you can find it for yourself and put it in the show notes, listeners, Justifiable Reasons Why You Can and Should Fire Your Financial Advisor. I did a quick look through the article here. I think this came in a while ago, so this kind of is, I think it's breaking down a summary of a firm, Natixis, has a global asset management survey from 2016 of individual investors. And they found in this summary, 30% of their financial services clients ended their relationship with their advisor because they did not offer the following services. So about 40%, close to it, probably the main one you would think of, which is they didn't deliver adequate investment results. That's kind of why you're going there, right? So if they don't deliver that, they're out the door. 29% saying they didn't listen to the investors' needs. 28% say they didn't understand their savings and retirement goals, kind of a related thing there. 26% saying they didn't share their views on investing. That's an important thing. If you want to go and trade some stocks or options and your advisor only wants to put you in T-bills, maybe you want to go elsewhere. Also, they didn't communicate with the investor frequently enough, 25%, or 22% say they didn't justify the fees. 15% say they didn't make an effort to connect with the investor and their family. And 14% say they didn't make the investor a priority. I want to add a big one, at least for the purposes of this show, which is obviously not in the article. But we would put it obviously in this show. If you're looking for a financial advisor and they don't have any basic options wherewithal. They can't do a lot of the things we talk about on the show all the time, basic things, buy you a protective put, sell you a covered call, wrap them together in a collar, understand some of the basic topics we talk about here like volatility and time decay and things like that. If they don't understand that basic stuff, I mean, you are paying these people at the end of the day, and you should be able to get something for your money. If they're just picking stocks for you and riding the market up and riding the market down, you can do a lot better. So I would add to this, my thoughts, my comments are, I would add to this article, Avery, that there should be a big line saying if they don't offer options in any way, shape, or form, go elsewhere. It's still hard to find, but you can't find. There's a growing number of advisors out there who do understand this stuff, tune into shows like this, go into things like the Swan 10 box events, or a lot of the events that Eric and his team over at the OCC, OIC are doing to educate advisors. There's a growing amount of content for them out there, so there's more and more of them coming to the fold. So you can look and find them, and reach out to folks over there like OCC if you want to find some. They'll help you, point you in the right direction, and then at the very least, you can get the ball rolling. Because if they don't offer that, then they're not really bringing a lot to the table. Let's go around the horn. Maybe Mr. Chris, we'll start with you. Any thoughts here? Any comments for Avery and this article they're sending in about when you should fire your advisor?
Well, I think when you're not comfortable with them anymore. Look, the reason we have advisors is to guide us and tell us what's out there and educate us about things that we may not know, such as options or different types of strategies that we can incorporate into our portfolio. So, I think if you're just not getting the results, if you're not comfortable with your advisor, I think that's definitely one of the things. Or if the advisor is not really being active, proactive, and telling you what's out there, because there's tons of different products out there. And I think an advisor has a tough job today, because they have to navigate all these different products and volatility products, and make sure that those things fit their clients.
Matt, any thoughts on this one? You agree with if they don't offer any sort of options knowledge, you should kick them to the curb?
Immediately. However, I like the article in that, it says trust your gut. Really, it's saying if you have a feeling about your investment advisor that is not a good one, do it sooner rather than later. Trust your instincts on this one, and your financial advisor, they do have a tough job, but if they can't keep your trust and they can't convince you, then you've got to move elsewhere, Mark.
Indeed. So there we go. That's our thoughts on that article. Let's move on to a question from B. Goldberg, saying, I have a large number of SMAs, those are separately managed accounts, obviously, listeners, with smaller balances. He puts in parentheses here, typically $5,000 to $10,000, coming in from new clients. So, well, good for you, or B, B, whoever you are. Could be a lady, we never know. Sounds like you're doing well there. He goes on to write, or she, most are younger clients willing to try their hands at newer products beyond stocks, including options. What are some good options use cases for these types of smaller accounts? We've been getting some questions along these lines lately. People have questions about use cases for smaller accounts, and I think it's particularly challenging for this audience because a lot of the advisor option use case that we talk about a lot here on the show usually involves, some underlying component. So it's a covered call, so of course you have to buy underlying and then write an option against it, or you're buying a put to hedge said underlying. Again, you have to have the underlying component, or perhaps you're doing both, you're doing a collar. So a lot of those typical use cases involve stock, which is going to be an expensive thing. If you only have $5,000 in your account, you're probably not going to be able to buy a round lot of some stock unless you're going really cheap, and then be able to write even a one lot against it or buy a one lot to hedge. So that makes it challenging, which makes it a good topic for, maybe there should be a whole show, but we can touch on it now, I guess, do a quick touch, and then maybe we can think about revisiting this as a full episode down the road. But I know, Matt, this is right up your alley, right up your wheelhouse over there at ORATS. What do you have to say here to Mr. or Mrs. B. Goldberg with small accounts?
Yeah, we just got a call yesterday from an advisor on this, and it's a very difficult issue because whereas it does sound like they have some sophisticated, at least people that are willing to try some new types of strategies, there are a lot of just operational considerations, like how you're going to get all these options in the right accounts, and how you're going to communicate what you're doing with all these types of folks. So, I would concentrate on something that, and we found this in the Cirilli report that the advisor understands a strategy that they can explain, or at least have some information for their clients, that they could clearly explain the strategy that they're doing. And there is some good software out there. I mean, you may be able to do some overlay strategies. That's usually the easier way to start on these types. And then I would say definitely a defined risk, because the smaller accounts, you have to really watch it. And then have smaller trades, and hopefully operationally you could pull it off. But those are the types of things that we're testing for these advisors, is how and then they could use that in their marketing material. So it's a combination of an understandable with some backup to it, and not too risky, Mark.
Was there any one particular strategy that, I mean, obviously you just kind of started looking into this because the call came in yesterday, but was there any one particular strategy or methodology that kind of stood out, maybe some basic verticals or things like that, where, doesn't require a ton of capital, they could utilize it even in a small account like that? Or are you still kind of crunching the numbers?
No, I mean, this particular advisor wanted some protection for, some high flying stocks. So we talked about callers, and if you could pull off a put spread collar, that you could save some money on buying the put. But those are the types of protection that that we talked about and are testing, and we could come up with some good ways to some of these investors have they were whipped around quite a bit in February, and they want to I don't know, deaden some of that volatility, and a caller can do that for you, Mark.
Chris, you guys obviously engage with a lot of different advisors who deal with a lot of SMAs and things at your 10th box events and others. I'm sure you've gotten this question before as well. What do you typically tell people who are in this type of position?
Well, I mean, moving on to the smaller accounts, just what I wanted to say about the $5,000 and $10,000 type accounts is, it can be very difficult to hold stock or underlying. So if you are looking for downside protection, if you wanted an overlay where you could insure your portfolio to the downside and fund that through selling premium on the upside, you may not be able to do the traditional collar where you have underlying in your account, but you can do verticals synthetically. We'll give you the same type of risk reward profile. So, I mean, we handle larger accounts, larger SMAs, where we can apply our defined risk strategy that we've been managing for over 20 years. So a little bit, it's kind of the same principle though, but we're insuring a portfolio and we're harvesting risk premium to try to pay for that insurance. But it is challenging for smaller accounts. But nevertheless, you can still mimic or create a synthetic structure that would have the same type of risk reward profile as a collar.
Yeah, it does kind of come down to the end of the day, it seems like, to basic verticals. That's pretty much the best way to go. A lot of the strategies we like here, selling a basic cash secured put to collect a stock, you can't really even do that in a lot of these smaller accounts. So that rules out things like a bullish risk reversal, which is a great way to get really cheap bullish exposure on an underlying you like without buying the stock itself, because you can't sell that put leg unless you do more of a put spread risk reversal, and that you kind of really kind of muddying the waters there a little bit. There's a little bit of talk. I know we talked about this before on our network about maybe some calendars or diagonals or things, but those get pretty challenging. You have to be a little bit more on the sophisticated end of the spectrum to be able to really manage effectively. You can do those with smaller accounts, but you kind of got to know what you're up to with those and babysit them a lot. So I think I would probably rule those out for the lion's share of these smaller accounts who are probably going to be on the more basic side. So I think, I'm with you, Chris, kind of like the basic vertical call spread. I mean, it sounds basic, account's kind of boring. It's not exciting. I know it's not like an iron condor risk reversal swap or something like that. But at the end of the day, it can be effective if you do it well, if you have an underlying you like and you're picking strikes that are done well, and you're doing good strike selection there. And then over time, if those start to work out, things like, we talked about before, maybe interesting too, we talked before about stock replacements. Maybe this is a use case for that, where you have an awful lot of capital, so you can't really afford to buy the stock. You probably can maybe buy some deep in the money calls farther out and maybe use again, it's going to probably tie up all the capital in your account. So if you're okay doing one trade for a year or two or 6 months maybe, then maybe that's the case. But yeah, it's definitely a challenge. I'd be curious to know some other people's thoughts on this, because we've kind of debated a little bit on the network now, and I'm kind of with Chris, I think, on the verticals. That's kind of where I tend to shake out. It just seems to be the easiest, most capital efficient. You could do a few of them even in a small account, kind of get your feet wet, understand it, and then kind of maybe go from there. This is a good question, though. It might be worth. I'm gonna make a note on this one, guys. Maybe we should come back to this on a future episode and really maybe devote some serious time to it in terms of these are strategies that are really good. These are ones that are more middling. These are maybe this is a good, maybe we got some homework for you, Matt. Maybe this is a good ORATS. Sounds like you're already doing it over there, so you don't need my prompting, but maybe it's a good ORATS one too. What can you do with like a $5,000 to $10,000 account out there, and what are some of the strategies over time that are effective? Interesting question. I like that question. All right, we got to keep rolling though. Good question. That was from B. Goldberg. Next question coming in. Leslie Necing. Apologize if I'm butchering your name. She's saying here, Morningstar has an option-based category for their funds. Yes, they do. You are correct. And she goes on to write, but it includes everything from volatility funds to overlays. So it's hardly useful for comparison purposes. What category should they include to provide more meaningful comparisons for people looking for options funds? You guys can find this for yourself, listeners. We'll put the link in the show notes, but you just search for Morningstar and options. It's going to come up. They link them. They call them options-based funds. They have a whole page with a bunch of the categories. They got all the Swan stuff and everybody else over there. And not the universe of options-based funds still isn't that big, listeners. Excuse me. And they break them all down by returns and things like that. But she's right. If you look at this page, you see a covered call fund next to a volatility fund, next to something like the Swan DRS, next to some sort of structured income thing. There's everything under the sun. It's kind of the issue we've talked about before, where I joked about it before, like the alts ghetto. Everything's thrown into the alts ghetto. This is a one notch down the rabbit hole. It's an option. We can call it the options ghetto because everything's lumped together. There's really no choosing. There's no rationale. There's iron horse. I don't even know what these things are. It could be an iron collar trader for all I know. There's all sorts of weird stuff in here. I'm sure there's a lot of put writing in here as well. And she's right. These funds are trying to do different things. Some are trying to hedge. Some are trying to generate income. Some are trying to manage your volatility exposure or speculate on that. So they shouldn't all be compared in one table like this. That's kind of what Morningstar is doing. I think she kind of kicked it off with a few interesting suggestions. I think maybe some sort of volatility-oriented category would be a good one because there are funds out there that exclusively try to manage volatility. I know Mark and his guys over there, Carmen Line, the other funds, they've just launched a volatility fund. The Typhon guys, they have volatility funds. So there are ones out there who exclusively will trade volatility, and they should be a separate thing. There's ones out there that are solely generating income, and they should be separate things. There are some that are kind of just basically looking to hedge, and they should be a separate category. So there's a lot of ways we can carve it up. I think that's a good starting point. Obviously, this is a conversation that's near and dear to your heart, Chris, and the team over there at Swan. I'm sure you guys probably have a lot of thoughts on this, but maybe we'll limit it to like 3 to 5 categories that Morningstar should start with. We won't go too crazy with them right now. Let's have some basic expectations. What would you like to see? I think there was some talk about them doing an option writing category, but what would you like to see from the Morningstar guys when it comes to how they actually break down these funds?
Yeah, so I'm in love with Leslie. So every time I'm at a conference or speaking on a panel, I've been pounding this issue that, let me give Morningstar a lot of credit for creating the option-based category to begin with. But however, a lot of different strategies are kind of thrown in there. So it's not apples to apples. I definitely think they need to separate hedged equity, option-based strategies that are hedged equity versus volatility only or risk premia harvesters only. So, unfortunately, the first week of February, there were some big events, and unfortunately some volatility funds did not navigate through that period successfully. And some of those guys are part of that option-based group. So we all kind of get lumped in together. And, well, if this event happened to this fund, can it happen to yours? And then we have to explain, well, we're hedged equity. We're not the same type of structure. So, yeah, I do definitely think that Morningstar has to do a better look inside the option-based category to kind of separate, the different types of option usage, if you will, that's being employed inside that category.
Yeah, I mean, I think we probably could go on the rabbit hole with like 20 different categories if you really want to micromanage. That's probably going to blow the minds of the folks at Morningstar. They could barely wrap their heads around creating a basic options-based category. But yeah, I think those just those basic categories, just that basic level, let's say 3 to 5 of the ones I mentioned, the income, the hedged equity, like you're talking about before, like volatility, maybe a couple others in there, exclusive option writings, like maybe make that the income instead. But something along those lines, that would go a long way. Just those 3 would go a long way to really starting to segment it. Matt, you probably talk about this a lot as well with a lot of your clients out there. What would you like to see added to the Morningstar categories?
I always want to bring this up, but if they have some type of a debacle ratio where they could show, how this particular fund would do if the market was down, 25%, 50%, or up 50%, and if volatility came down, because it's unfair to compare a hedged fund with someone that's, basically unhedged. Look at what was it, LJM, that, the one big move to the downside and they're out of business. That the debacle ratio would have shown the risk down there. And if you show some predictive risk, then investors can invest with a lot more confidence, or at least they know what to expect if a certain thing happened. And then you can compare different funds that have different, similar risk characteristics. And I think that if they could pull something like that off, that would be great, Mark.
I like it. I'm a big fan of your advisors' advice. Your debacle ratio. I think it's a good one to have. Not the last time we'll probably discuss it. Great question there, Leslie. And yeah, I think at least those basic 3, like a hedged equity, a volatility, and some sort of income/option writing fund. You can get farther. You can segment the income by just short put funds or other types of funds like that. So people get spooked about short puts. We all know covered calls, short puts, same thing. But people get spooked by that. So maybe you want to go down that rabbit hole a little more. Or you get some more esoteric things like that. But if you break down those 3 categories, you kind of just broke down 70 to 80, maybe 90% of the options based fund universe out there. So you're not missing a lot at that point. So maybe that's a good starting point. Here's one that is not up my alley at all, so you guys are free to weigh in on this one. This comes from Scott Somer. He writes in a lot to the network. He asks here, how would movement, I think it means the movement, to treat capital gains to FIFO, so that's first in, first out, for the underlying stocks be good or bad for the options market? I know you two are both master CPAs with years of accounting experience under your belts. So maybe Chris, we'll start with you. I'll give you the pride of plays on this one. Any thoughts at all on FIFO? I have none.
Well, I am not a master CPA, but I appreciate the plug. I really have no opinion on it. I mean, this one needs to go to a real accountant, a real CPA that knows underlying tax issues in conjunction with option strategies.
Yeah, I was of course just joking. No CPAs here on the program. I'll spare you, Matt, unless you have some real thoughts on this.
Mark, I got you said you weren't going to talk about my personal background, but I actually do have a CPA.
Do you really? I was just joking.
I do.
Oh, there you go. All right then. So you are therefore now you have the pride of answering this question. Go for it, sir. See what you get for your degree.
Yeah. FIFO are the stocks that you have longer. LIFO are the stocks that you just have put on. So you probably have more, let's just say, especially in this market, you have more capital gains to report on the FIFO basis. So just from that, I mean, you'd probably trade less, or but then again, you might want to protect those gains by using options. So it's, when I first heard you talk about this, I was thinking, well, it's going to create less options trading. But, then again, we do a lot of testing of these, what is it called? Concentrated positions that our clients have on, where we're they don't want to sell the stock, but they want to take some risk off the board, so they'll use options about it. So I actually think it's a good question, because it makes you think about it both ways. One, you're not as likely to trade the underlying, but 2, you might want to use options about it. So on balance, maybe it is a good thing for the options market, Mark.
There you go. You heard it from a CPA. I was just joking, but we actually do have a CPA lead. You never know what's lurking there in the background of our show. So I guess send in your questions, even the esoteric tax ones, and we'll see what we can do about it here. I got a comment just came in from Papa Scalp. I like that handle, so he gets on the show too. He's saying what's scary to him is how many, and he puts in quotes, advisors don't have a clue, not even for portfolio protection or insurance. He's talking about the advisor's lack of education when it comes to options. Yeah, we're with you there, Mr. Papa Scalp. I like that handle. Yeah, you're right. It is. That's kind of the whole reason, the genesis for this show is that there's just, we first started. I'll tell you a really quick story. This is many years ago now, but when we first, I think this is actually before I even started the Options Insider. So you're talking pre-2007. It's probably 04, 05. I was contacted by, I think it was Financial Advisor magazine, to do a big feature about how advisors use options. And I said, okay, put me in touch with some financial advisors, and I'll see what they do, and I'll analyze it, and we'll write about it and talk about it in the magazine. And so they put me in touch with a couple of large nationwide organizations that had membership spanning the country. I reached out to both of them, said, hey, full membership. If you guys use options, reach out to me. If it's interesting, I will profile it in this piece. So a nice little bit of free exposure for them. A lot of people hit me up. Nobody, I think 2 or 3, had any sort of options wherewithal, and there wasn't really much to really write about. So at the end of the day, the article kind of became a bit of a challenge in terms of analyzing anything. But that was eye-opening to me back then of just how little penetration there was when it came to basic things for options and financial advisors out there. And it was kind of scary, quite frankly. So fast forward a decade or so, and we have this network now. We have this show. There's a lot of great research being done by the team at OIC. There's events like the 10th Box and others, and Matt's out there, arming advisors with data. So the situation has changed quite a bit. But still, you're right. There's a long way to go, Papa Scalp. And you're right. You still have far too many of these advisors out there. You come into their office and say, okay, how old are you? What's your quote-unquote risk tolerance? Okay, here you go, 60-40. Or maybe if they're really, really active, 60-30-10. And they kind of feel like they did their job for you, and that's it. So you kind of want to avoid those guys. You want to get the ones who are much deeper down the rabbit hole, talk about this kind of stuff, and then hopefully it will work out. All right, another question here. F-Knight 67 asking, is there one position or strategy that you feel applies best to the vast majority of financial advisors and asset managers? Well, I think for us here on the show, I'll go first. I'll give you guys time to think. But for us here on the show, we've talked about it before. In fact, we have a whole episode we call the Holy Grail for Options Holy Grail for financial advisors. And that is, of course, the old collar, because it kind of combines 2 of the things that most advisors out there are doing anyway. They're writing covered calls for income. That probably covers the vast majority of advisors out there. And you have a smaller percentage out there who are also buying puts to hedge. And so they combine that into one position. It's the collar, it's hedging, and it's got income. It's kind of the best of both worlds. You could jazz it up like the folks at Swan do with some other extra legs and things to make it even more attractive. But I think the collar for me is the one that I always start with for a lot of it. I think you start with the covered call, but then you move up to the collar. But to me, the collar kind of combines the 2 needs that most advisors out there seem to have on behalf of their clients. Matt got the CPA question, so let's go to Chris. Chris, what do you have to say for F-Knight? What's your idea for the one position or strategy that you feel applies best to the vast majority of financial advisors and asset managers?
Well, we have to ask what's the financial advisor's goal here, right? Well, first is preservation of capital, okay? And then second is to produce positive returns. In other words, add income, right? Incremental returns to a client's portfolio. So, moving along with some type of insurance on your portfolio, kind of like what we do with the defined risk strategy, is definitely something that financial advisors should be armed with. And if you can do it in different ways, putting the covered call so that you can get some income to pay for some of that long put, for example, is a good way. And kind of what we do a little bit spin is we are heavy into the harvesting the risk premium, which a lot of people have been talking about. So something that ensures an overall portfolio, but then can also add incremental return is really probably the very first thing that any financial advisor should look into.
Yeah, Mr. Matt, same question for you. You actually crunch the data on a regular basis. So what would you say is kind of your go-to for advisors out there?
Yeah, I mean, we saw this really study that not a lot of advisors are using options. So if it's the vast majority, it has to be the simplest. And like Chris said, the preservation of capital has to be top on their mind, especially if they're into, long leaning maybe stocks or indexes that they already have for their clients. So I say the good old fashioned long put. I know it's not going to be that popular, but and we're finding just much more out of the money. Just have some protection on it. Even if you think, and we saw this with Tesla, even if you think the stock's not or the index is not going to get there, what will happen is if the market goes down hard, the volatility will expand, and even if your puts that are way out of the money now are only out of the money now, they'll still expand quite a bit. So, find an amount that you can insure, and most insurance expires worthless. So, talk to the client about, hey, let's have a little bit of protection on it. Let's just have it way out of the money. Maybe give it some time to maturity. Maybe stagger it a little bit. So I don't know, 100 days, and then when it gets down to 50, put on another one, and then you have some protection at least. And so if the worst happens, where the strike price is where you're going to stop the pain, but it'll stop a long way before that. So that's what I would say, Mark.
There you go. Three different but related suggestions for you out there. See who sent that one in. That was F Knight 67. Next up, we got Mark Brandt. He writes in all the time. In fact, he just sent in a couple more while we were doing the show here. So usually I limit people to one question. He's got a couple here, and he writes in a lot. So maybe we'll allow him to have to again. First off, he has this kind of general, I guess, poll question, which is, do we think rising vol will persist all year? VIX above 20, VXX above 40 for half the time. Well, spoiler right now, since you sent this in, VIX is below 20. It's about 15.5 right now. So we're in the tail end of that range. VXX is above 40, but barely. It's like 40.5. So I think I waited on this. You sent this in before on some other ones. I've waited as I'm going to keep my no answer. I think probably will be some moments of elevation, but I don't think we're going to be there for half of the year. He also asks, Chris, this is for you, obviously, what is the current version of the SWAN process? I don't know if you guys have changed. I think it's pretty much the same process, but you can elaborate on that. And then it sounds like he just sent in the third one. Sounds like it's for you, Matt, saying someone should backtest how often fading the skew by buying the cheaper options wins. I've seen it a lot, but that is a tiny sample. Could be a data mining edge there. So a lot to unpack here in this triple question. Let's start off with you, Chris. Let's do. What is your vote on this? Do you think VIX is going to be above 20 and the VXX, of course, is related product, above 40 for half the year? You think we'll be more like where we are now, which is below it? And then B, he's looking for an update, the current version of the SWAN process. What are you guys doing out there day to day, and has it changed much over the last, let's say, 5 or 10 years?
Well, as far as volatility is concerned, I know Matt and I still have a bet that I'll be plus 15 at year end, and he's going to be sub 15. I do think, that the single-digit regime is over. I don't think you're going to see VIX below a 12 too many times this year. I'd be very surprised to see it get back down there. But I don't think that you're going to see too many prolonged periods above 20 as well. We just had an event, and the thing about markets is that every time that you have an event, the next time the event has to be bigger for volatility to have a bigger spike. So we're already used to this event. We're already used to going down and testing the 200-day moving average. We bounced around it for several times, and the marketplace gets more and more comfortable every time we go into the same area. So we're going to have to go into a new area, meaning for volatility to get elevated, the market's going to have to crack that 200-day moving average. We're going to have to see something new for volatility to be persistently rising for the rest of the year. But I do think that we're going to be pretty much 12 to 20 for the rest of the year. I think 15 is going to be a pretty good support. If you look at the VIX for 2017, 15 was essentially resistance. So basic technical analysis, what was resistance should be support in the future. So I do think that 15 to 20 is where we're pretty much going to be for most of the year is my prediction. I do think you'll have some stabs down at 12, and then you may have some stabs in the high 20s as well. As far as the SWAN process is concerned, well, we're still doing the same thing that we've done for 20 years. We are a hedged equity product, so we have underlying and then we buy a longer term put. I know we've been talking a lot about protection here. So, a lot of other strategies hedge with shorter term protection. And, February 8th, February 5th, the first week of February, when these short volatility products were blowing up around us, that was a good example of how expensive short term volatility became. And it could be cost prohibitive to hedge out your portfolio. So we go into the longer term space as far as protection is concerned, and then we harvest the premium by selling or shorting shorter dated options to try to fund that.
There you go. A good update for you. Mr. Matt, same question for you. We've kind of already weighed on this before, but you get to weigh in on it again officially. VIX above 20, VXX above 40, half the year, yay or nay? And then what do you think about his backtest scenario is a little vague. He says, fade the skew by buying the cheaper option. So does he just mean, like in the case of an index, you buy the out-of-the-money call? Because this year it's worked, but usually that's not a winner. Or does he mean buy the call and sell the put and kind of do the risk reversal? I don't know specifically what he means. So maybe if you have thoughts on either one of those, and then B, what's your vol vote for the rest of the year?
Yeah, no, it's a good question. I'll start with the vol. I'm bearish, as Chris said. I'm going to probably end up going down to Puerto Rico and buying him dinner after year end, but that's a good and bad thing, right? I think that a lot of this volatility is kind of man-made. I think overall the whole climate is so good for earnings, and the state. The deep state is getting so much stronger, and all these big firms that are tied with them are, doing so much better. They have all of our data and everything. So, it can't, if the market just continues to go up, higher prices, it's going to be lower volatility. So I'm bearish on vol for those reasons. And then on the way I understand the question is there's a very steep skew, especially in the SPX, and I think what Mark is asking is if you buy the cheaper options, I think in terms of implied volatility, and sell the most expensive ones. And actually, I do like that strategy. I have something on. And that we're testing right now, and we've actually come up with a new trade adjustment feature. So, what we're doing is buying the at the money, selling 2 out of the money, and then buying 3 or more very cheap out of the money puts. So it's kind of a broken wing butterfly with, I don't know, a calendar added to it. But I think that's what Mark Clyde Bryant is saying, is fading the skew. There's a very much of a sweet spot where the skew it's so steep, meaning the low strike or the put implied volatility is so much higher than near the money that there is some I think that's what kind of feeds what he's saying. There is some return to be had there. And as far, what we're finding too is you have to be a little agile. What that means is if you do have these positions on where you're, short near the strike, if the market starts going towards that, we have this, that's our trade adjustment new feature that we have in our back tester that's really helping these types of strategies. So you just kind of move the strikes away, but you get, you don't lose too much money because the way out of money puts that you have ratioed on blow up. It's kind of a complex strategy, but I think it is a good thought that he has, and there are some strategies that you could really take advantage of that, Mark.
Let's see here. All right, next up, Alan Tullman saying there's a lot of research last year regarding selling put options to harvest risk premium. Now that volatility is back, is this an ideal time to harvest premium via put selling, or does the increased volatility increase the probability of getting whipsawed? He has a good point. Matt, you and I talked about this before. We were down at the risk management conference earlier this year, and in recent iterations of that conference, particularly last year and maybe a little bit the year before too, it was just like, it seemed like every other presentation was this quote unquote harvesting the risk premium by selling out of the money puts. It's like every research firm, every fund out there had collectively awakened to the magic that is selling whatever 3, 5, 10%, pick your poison out of the money puts in the indices or in equities or in commodities. It was across the board. It was just put selling was the trade of the week or the year, depending on what research you saw, the trade of forever. It was kind of funny how everyone just collectively just glommed onto that strategy. That's almost as old as options itself. Not quite, because there were no put options when they launched, but as soon as put options came out, people started selling them. So pretty old strategy, and yet for whatever reason, everything old is new again. That strategy was suddenly cutting edge, and everyone was doing it. And then, of course, we saw February, where a lot of those put selling strategies, where if that's all you did and you didn't really have good risk management on, it kind of hurt. And we saw a lot of funds blowing out. As a result, we heard later then that some of these funds that blew out weren't just writing one put. They were doing crazy levered things, 1x5, 1x8. I heard one of the funds that blew out, it was 1x8 on both legs. So they were short 8 to the downside, short 8 to the upside. So they kind of got it on both ends of the spectrum there. So sport, that's not a good, don't go down that route, whatever you're doing. Not a good bit of risk management there, unless you're doing something that Matt's got, like where you got some other thing beyond the wings to hedge it there. But still, yeah, this is not suddenly an idea that was very fashionable, very favorable, particularly in a time when there wasn't a lot of vol. Trying to find new vol was a fun thing to talk about. But then all of a sudden, vol came roaring back, and it got a lot of people spooked, a lot of people scared, and they kind of stopped talking about this. But it's an interesting question to discuss here on the show today in terms of is it time to start blasting out them old puts again? Mr. Chris, let's start. Let's go back around the horn that way this time. Mr. Chris, what are your thoughts here? You guys obviously do a fair amount of put selling as part of the DRS. How does that compare and contrast right now versus, let's say, back in the volatility doldrums of Q3, Q4 2017? And do you think this is a good time for people to start looking at that strategy?
Yeah, we need to put things into perspective, because 2017 lulled a lot of people, and it was, I think Matt said it on the last show that the volatility of 2017 was a tail risk event. It was so low. So just because volatility, I guess I'm in quotation saying volatility is back, but had we not had a 2017, had we not seen single digits in the VIX and it, hovering around 12 for the better part of the year, would we be talking about this right now? Probably not. All I'm saying is that volatility is at a more normal juncture today, a more normal regime, if you will, historically. So if we step back, well, we've been harvesting premium for many, many years through all kinds of different volatility regimes. So just because we had a low vol year in 2017 shouldn't scare anybody that, well, volatility is back and we're going to start getting whipsawed. Well, you know what? We've had these years before. We've gone through the financial crisis. We've gone through, the credit downgrade in 2011. So volatility is going to cycle just like markets. So, and the premium, the risk premium is something that is always present. Now, sometimes it can be challenging. There are periods sometimes when you are in a transition where realized volatility is a little higher. That can make premium harvesting strategies a little challenging. But at the end, it normalizes itself, and selling premium is still a good strategy. But again, it has to be in conjunction with solid risk management. Selling premium is not a bad thing. Selling premium and using a lot of leverage can be a bad thing.
There you go, Mr. Matt. You're crunching the data 24/7, 365 on all these types of things. What is your data telling you about selling puts now versus, let's say, 6 months ago?
So one of the strange things that I did find about all this back testing that we do is it's counterintuitive, meaning in low volatility situations, the market doesn't get the volatility low enough. And in high volatility situations, the market doesn't get it high enough. So what I think we're in right now is the person that asked the question is talking about getting whipsawed. That says, statistical or historical actual volatility. Yes, there is quite a bit of realized volatility compared to implied right now. We see it calming down a bit. We do a lot of intraday studies that we think are more predictive than just close to close. But it can be tough in these type of situations where volatility is coming, volatility is going, it's coming again. We find, again, counterintuitive, but on the lower end, last year was a very good year because it was on the low end, and they just can't get it down to the levels of realized volatility. You might be at a 9 implied volatility, but realized as a 6. I mean, right now it might be around a 15 implied volatility, but realizes it might be 17 or 18. So, as far as the question goes, I think it's a little tougher right now to be short. There are definitely more opportunities if you know where to trade and where that skew is, like we talked about in the last question. But that's what we're seeing, Mark, is that it's not as good right now as it was in the year before.
That's funny because that is such a counterintuitive result, I think, to a lot of people. But we talked about this last year. Even though there was a lot of opportunities to sell premium last year, it is counterintuitive because the net amount of premium you're collecting is lower. But that harvesting the risk premium, remember, the risk premium is the differential between the implied and the realized volatility. And if your implied is still 2, 3, 3.5 points higher than the realized, and Matt's right, there's only so low that really can go before you're not going to get implied in the S&P below like a 6. Probably if you do, then it's really just a wasteland out there. So there's a limit to how low that can go. So even when the VIX was floating around single digits and 9, everyone was lamenting. Realized vol was still like a 5, 5.5. So you're talking a 3.5 point premium there that you can still harvest. It's contradictory, but it does still happen. Now, of course, you got to be prepared for these moments like February 5th and 6th when it comes roaring back to life very aggressively. It is interesting. You see the big juicy vol numbers now, and you get really excited about selling some premium. And you're right, net juiciness wise, it is attractive, but the chances of that vol coming back to bite you are higher too. So it's worth being cognizant of that. Check out some of Matt's data. You can see for yourself just exactly what people could do last year and versus right now, where we are kind of in this weird volatility zone where we're in the mid-teens, but who knows? Another tweak could send us back into the 20s, or we could settle out around here, maybe a little bit lower in the low teens for months. It's one of these weird scenarios. We could debate vol for a while. We got to keep going. A couple more we have time for here. It's amazing. Even with the whole listener question show, we still don't have time. People are sending them in as we speak. We answer them, and more are coming in. It's like we're digging out a hole that can never be, or filling in a hole that can never be fully filled in. It keeps digging itself out. This comes from Nevos. This is for you here, Chris. He's asking, or perhaps she, there are a ton of tickers for the Swan DRS. Are they pretty much all the same, or is there a primary fund that I should look for? And they're right. I'm looking here at the Morningstar page you were talking about earlier, and there's a bunch. There's SDFIX for the emerging markets. There's a SDCAX, which is defined risk for small cap A. There's small cap C. There's a covered call institution. There's a small cap A. There's foreign developed 1. So there's a lot of different defined risks. Maybe set this slew of tickers straight here for Mr. or Mrs. Nevos, Chris.
Yeah, so we have our 4 major mutual funds. One is large cap, which is SDRIX. Then we're going to have our small cap version of the defined risk strategy, which is going to be designated with the C, right? And then we've got emerging markets and foreign developed as well. So they are all the same type of strategy, just the different underlying. Now, you may be getting confused. Well, there's A shares, C shares, and Class I shares. So it really depends on the load. So Class A has a front load, and that's imposed on purchases. And then Class C is going to have a deferred sales charge. And Class I would be your institutional class, which I believe requires a minimum of $100,000 investment. But they are all still the defined risk strategy, still the basic premise of always being invested, always being hedged.
There you go, Mr. or Mrs. Nevos. Ask and you shall receive. A question from Bill T. Bill T asking, is there a platform you recommend for advisors looking to onboard more options clients? This has kind of been a question that has plagued the space for quite some time. I remember years ago back at the options conference in New Orleans. This is 5-6 years ago, probably now at least. They asked me to chair a panel on the advisor space and the use case of options. And we debated for a while this very question. which was, what are the best platforms? Advisors are always saying, these things are terrible. The retail guy with $20,000 gets all the bells and whistles. I come to them with $200,000 or $2 million, and I get a glorified spreadsheet and some backdoor platform I have to log into to manage my accounts. It's terrible. And at the time, it's funny. We all kind of came down on the panel to the side of saying, yeah, Brokers Express was kind of the best game in town because it was designed for this clientele. And then literally a month or two after that panel, Schwab shut down Brokers Express. So that kind of went away. So there's been a few other players trying to vie for that since then. A lot of people talk about think pipes. That seems to have some decent cachet and some penetration in the space, but I hear some pros and cons of that platform too. So it is still kind of a bit of a wild west out there. I know, Chris, you guys at Swan ended up having to kind of to build your own, right? Because you couldn't really find anything out there. Is that that's obviously not a way everybody can go. What would your recommendation be for firms out there? Maybe you guys are licensed in the Swan Tech. Is that way you can have a Swan Tech spinoff soon?
Yeah, possibly. I think ThinkPipes is a pretty good platform to begin with. Everything that's available through TD Ameritrade. Again, it depends what you're comfortable with. How you're going to look at your positions, how it's going to disseminate your risk is very important. So you need a platform that's going to be able to break down your positions, show you risk runs, if you will. That's extremely important. But yeah, I mean, we've developed our own internal technology so that we can handle multiple strategies over multiple accounts.
Yeah, it's kind of unfortunately. Yeah, maybe contact Chris. Maybe we'll point you to the tech guy over there. Maybe they'll be interested in licensing it. Who knows? This is a question that comes up quite a bit. ThinkPipe seems to be the kind of one of the few firms standing that looking into space. But I don't know, Matt. You're obviously active on the advisor tech side. Maybe you have a recommendation, or maybe this is a new business for ORATs you're planning on spinning up here.
Yeah, it's funny that you say that, Mark, because I have used a number of them, and I'm not terribly excited about them. So we are dipping our toe in there. One of the things that as a past market maker and someone who backed a bunch of traders on the floor, managing risk was paramount, and even institutional trading software doesn't really do risk that well. One of the things that ORATS puts out there is, if you have a systematic trading system, you can simulate what you're going to do in varying market situations. So, a lot of when you say slides and when you say, if this happens or that happens, it's mostly a static environment, meaning you have a position on right now and you're not going to be trading through that kind of situation. What we're putting together, which I think is pretty revolutionary, is trading through these difficult markets and trying to simulate and continue the back-tested trading rules that you have going into it. So what we're doing is every position that you have on is marked with the back test where you would exit, and then how you would continue to trade through these difficult types of situations. And then we simulate these different markets, and you could walk through what your rules are and then see how you do afterwards. I'm not sure if that's making much sense, because it is kind of revolutionary and it might be a little bit confusing to listeners. I mean, it is a new thing that we're testing out. It's not an easy thing to program, but I think it's really interesting to see. You put these different scenarios together, but you could do it over, a few days. For example, a lot of these market crashes that we saw happen, the market starts going down 3-5% before it goes down 15 or 20%. What are you going to do in those days before? And what we're trying to do is simulate using trading rules, actually being able to trade into that difficult market environment, Mark.
Yeah, it's funny. I've often joked here on the network that if I had the time to spin up another business, it probably would be something like that. It would be something geared toward the advisor space and just giving them some good basic options of platform and software to use, because there's such a clear, demonstrable need out there for this. And people have been saying it to me for the better part of a decade. And Brokers Express was the one. They went away. And you're right. Everyone tells me, yeah, I kind of use ThinkPipes because they're kind of the only game in town left. But I'm not really excited about X, Y, or Z part of their platform. So no one's ever raved to me about ThinkPipes. So there isn't really the answer. Long answer to the question, or I guess short answer, really, after a long conversation, is there isn't one. But maybe stay tuned to ORATS. Maybe they'll ThinkPipes is the leader for now. But maybe stay tuned to ORATS. Sounds like you got some cool stuff cooking over there under the hood. I'm looking forward to seeing it, because if I can't do it, Matt, I'm happy you could take that ball and run with it. All right, that music, listeners, may be amazing. We've come to the end of an hour already. It's amazing how quickly time flies when we're answering your question. Look at that. We spent a whole hour, a whole show on it. We still barely scratched the surface of your questions. Keep them coming. We answer them all directly. We try to get them as many as we can on the show whenever possible. So keep them coming. I know by the next show we do, the well will have filled up again with more questions. We love it. We look forward to it. Good stuff as always. Great questions, everybody. Before we go, let's go back around the horn. Let's start with Chris, because I know, Chris, you guys are coming to Chicago soon, right? So what do you guys got cooking over there in the land of Swan?
Yeah, you're right. We're gearing up for our CIO conference in Chicago. That's going to be next month, May 14th and 15th. We actually have a new white paper out. It's tax efficiency of the defined risk suite of funds. And then, as always, we continue our 10th box seminars, which is a series of regional due diligence meetings. It's a good opportunity for advisors, investors to sit down with the portfolio managers and discuss whatever challenges they may be facing in today's marketplace and how the DRS can be part of their investment solution.
There you go. Check it out, and look for some good content coming from us at the big Swan Forum in Chicago next month. And Matt, in addition to your forthcoming suite of advisor-oriented option platforms and products, in addition to all that, what else you guys got cooking over there in the land of ORATS?
Yeah, we're doing a lot in earnings. Earnings season is just starting, and as you know, we're sending you some of our reports to post on your blog, so your listeners can go there and check out some of the work that we're doing on earnings. It's really important to spend the time to see what the options market is expecting in these earnings moves, and we have a good method for doing that, where we simulate where the volatility is going to fall to, implied volatility is going to fall to after earnings. We have a good distribution, so to see where the straddle will be, how much time's left in it. You have to be quite sophisticated in order to get it right. So that's been a fun thing to watch the earnings just starting off here and see how the report's doing. And then, of course, like you mentioned, we're looking a lot at risk, and we're looking at improving our back testing platform. Like I said, we're putting in these trade adjustments. That's been very interesting, Mark.
There you go. Check it out for yourself. You can always follow them. Follow them over there on Twitter. Just Options Rats. I like that handle. Easy to find. Or head on over to the website, ORATS, ORATS.com. As Matt mentioned, they got a great blog there. You can also check out a lot of their stuff via the Options Insider. Some of the great earnings reports you guys have been asking us forever for some great data on earnings and analyzing the straddles. Well, Matt and his team is doing just that. You can find it over there at the blog, or of course at the Options Insider as well. And last but not least, he's out there traveling hither and yon. Again, I'm going to catch up with him next month, or actually in a couple of weeks, at the big Options Industry Conference coming up. Mr. Eric Cotton, his advisor team. Meanwhile, if you want to check out all the great data and funds and stuff, they have some new funds coming out soon, new studies coming out soon. You can find it for yourself, optionseducation.org. Click on the advisor tab, and you too can check out the great data that is helpful when you're sitting down with your clients and they ask you, what's the deal with these option things? You'll have some data to answer those questions, which is always nice. So on behalf of Eric and our friends over there at the OIC, as well as Chris and everybody over there at Swanland, and Matt and his team at ORATS, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing, and of course, for sending such many and varied questions. Keep them coming, and we'll see you next time on The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.